This region around the Great Lakes has been called the heartland. When it comes to agriculture, there's hardly an area in the world that compares.
Everybody, just hold on. I don't know what we're going to have here.
That's what brings the viewers back. That a boy.
Manage money, piling in.
Double digits higher.
So at this point, we're in kind of uncharted territory.
There's a lot of money on the sidelines.
So that was a crazy one.
Good morning, everybody. It's Thursday, August 14th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you had any questions or comments, please feel free to drop us a line in the chat area. I'll be sure to get to it during the show. Overnight markets here at September corn down 3 3/4 at 370 1/4. September soybeans are down 7 1/2 at 1016 1/2. And September Chicago wheat was down 3 3/4 at 503 1/2. A couple of export sales announcements here this morning. We had 136,000 metric tons of corn to South Korea for 25. Also announced was 132,000 metric tons of corn to Spain, also for new crop 25. Weekly export sales were out this morning. We had some rolling of old crop sales into new crop. So net cancellations on old crop at 88,700. Solid for new crop sales, 2,047,800. That was the upper end of the range there. On the soybean side, same story. Net cancellations at 377,600 for the old crop, and then real solid on the new crop, 1,137,000, which was above the upper end of the range there. Good wheat sales, 722,800. Upper end of the range was looking for 850, so that was at the top end there. Meal sales in line for old crop, 26,300, and solid on the new crop, 246,700. Good morning, guys. Nice to see the business and see these sales. Certainly been an interesting trade. I guess really the only really big headline I see here this morning is we're going to be coming up on the Trump-Putin meeting tomorrow in Alaska. So I think that's is on the forefront of a lot of people's minds, and we'll see if we can get something done there. I guess so. With that, Dustin, maybe share a few thoughts here with us this morning, and we'll throw it around the room.
Yeah, we're real close to that contract low again in D's corn. I think if you go through just all the scenarios at this type of acreage number, we really are probably starting out at a much higher carryout, than a 2-1 is what a lot of people would read on the bottom of that WASDE report. It's really probably more like a 2-6, and we have to go prove a 2-1 through more demand if this is the yield. I know the market is kind of, it actually has performed really well for as much of a production number as they wrote down. I think a lot of people are poo-pooing the number, the 188 plus national corn yield number, especially at that acreage. But, let's say you take that back down to 185 even, we still have a long way to go to burn through that excess supply at that type of an acreage number. So, end of August, end of the line for old crop bushels. Many basis only contracts are going to need to be priced here end of the month. I'm not surprised to see corn back near the lows. I am a little surprised to see beans come off of it though. We'll see where that goes. But my personal opinion is that still the ratio will perform well, and the ratio meaning beans divided by corn.
Yeah, it's a good it's a good segue here. Matt Norman makes a comment here this morning, and I guess Justin, I'll throw it to you for your tinfoil hat here. But what price do we estimate the fall lows for corn and beans? And also, will we trade past a 3-to-1 corn to bean ratio?
Yeah, good question, Matt. One thing we didn't talk about, Conab came out today too and took a page from the USDA with their August numbers. So they raised second season corn acres a little bit, and they raised yield. So they increased their second season corn or total corn production 5 million tons. So that's another 200 million bushels. And I think, right now we've been, Brazil's just been shipping a ton of beans, right? And their corn hasn't really been shipping out. So we've been the cheapest corn in the world. That's why we're doing so much business, and I think the question is going to be, how that changes. We tightened up our bean balance sheet here. So we've had a nice rally. So South America is still probably going to be aggressive on on soybeans because of that ratio and trying to continue to ship. But how much do they have left? Do they have 10%, 20%? When does that switch over to corn? I think the fear is with the big corn crop there, that eventually when they make that switch, they could be competing with our gut slot and corn too. And maybe it's, call it December through March, somewhere in that time frame, which has been the trend, is that second season. Safrinha crop's gotten bigger. So where the lows are, that's tough to say. I mean, to Dustin's point, and we do this every year, right? We if you have a really big production number, we increase demand. And that's not just, we don't just use it because we have to, we use it because the price goes down to a level, and the job of the market's to get that demand, to gain that demand, right? To put that in balance. So, to Dustin's point, if you were to cut, 300 million bushels off the supply, you'd probably cut that off demand too. So we have, call it 500 million bushel demand buffer there, right? For yield cuts. So that's the tricky part, especially with a big South American crop. And I think we've gotten the windfall of that demand because of all the things I just talked about. So long-winded way to get to, what the lows are we've talked a lot on here about, the dynamics of, crop insurance, farm bill. That doesn't necessarily mean that the prices don't go down. On an individual level, there's a balance there of how to, call it trade or hedge around that, all those different tools that you bought. But we've had government programs in the past, a lot in like the 80s, 90s, 70s, right, where there's price controls, and that didn't necessarily, that just kept production going and kept prices cheap, actually. So you can't rule out, sharply lower prices, even if the government's footing the bill. You could see, I don't know, 320 corn if you believed all these, the yield numbers. If you took everything at face value, and then South America really started hammering the export market, really tough question.
Yeah, and that's
just one more thing. The ratio, I think the setup is certainly there to see a 3-to-1. That probably won't be till maybe spring, and maybe you run into some issues in South America, because that first season, right, in South America is mostly beans, and then you get that little bit of corn, but you get the big corn acres are second season after beans. So I would think that'd be kind of a spring situation where you would get to something like that, but the setup's certainly there. So the tricky part with the ratio is a lot of times you think it might be, maybe beans are rallying to 12, and it's really corn breaks to 3. So I feel more confident on the where the ratio could go versus like how it gets there, because it's tricky. You can't. I think it's hard to draw a line in the sand and say 390 is as low as corn can go. I've just made that mistake too many times. So
that's a good point, Justin. And I guess somebody brought up yesterday. So you've thrown 188 at the market. We're doing, I don't know. I don't want to use the word spectacular, but it's been solid demand, solid sales week after week, really good sales, right? So the question was, is the market at 390? Is it trading that yield?
I don't know how you know that. But this isn't like uncommon for a supply bear market, right? Look at corn. It's just been trending down since basically February, and we've been picking up demand the whole way. And if we have a really big yield, this trend will continue. We'll keep chugging lower. You'll see big volume the lower we go. That's been the case for a long time in these kind of markets. So try to look at the good news is we have the demand. It's going to keep picking up. You've got good margins for the complete animal sector, ethanol sector, exports. We're trying to find that number. To say how low it can go, that's just it's a really tough one. I think I'm more probably concerned with the timing of the lows and the timing of these things and how it fits into crop insurance, right? Because you could rally month about, you could make a low, I'll just call it number, say 380, maybe you make a short-term low, have a decent recovery, kind of get out of a lot of these payments for people and back to levels that aren't exciting. especially if we have big yields, call it $4, $4.20, something like that. You could even see, and then crop insurance expires and we break and make new lows down to 360 at the end of the year. That wouldn't surprise me either. So I'm kind of trying to really look at the levels, the timing, all these things Dustin's been talking about a lot on the show and in our letter, on an individual basis, because that's just hard to outguess it.
Yeah.
Because then you start looking at marketing year averages and farm bill, and if you get deep enough, like if you were to, let's say you broke down to 360 now, and you had the entire curve well below the farm bill, well, you can go hedge that marketing year average now. So the deeper and lower we go earlier, I think that's much better for growers that are willing to hedge and trade around those things.
Be dynamic,
because then you have a lot more certainty.
Well, I want to add to that too, because someone said this perfectly yesterday. Is like this 188 yield numbers might be a gift, right? And so, Gavin, if you can show this first, just this bar chart or the column chart. So this is like a lot of noise on the screen, but basically your dark blue line is your August yield, and then your green line to the left of that's going to be your starting over those years for a starting USDA trend. So 3 of the last 6 years, the highest print of the year is in August, and we've trended lower. And so you think about the survey of this report, a lot of it's satellite data. If there are some hidden problems, pollination problems, things that are in this crop that we will find out later, perhaps this is a year that we may come back off of that ultra high August print in some of those years. And let's go to the next chart, Gavin, that I put up as well, which is the seasonal. And I've already talked about this before, but if you're going to go put up a big number and the market's actually going to be impacted by that estimate, like we are talking right now, we had to raise demand up 1 billion bushels from what it was printed last August WASDE for the year ahead. We have demand up 1 billion bushels from that same report. So there's a lot of demand that can come off of that. Like we're 850 million bushels above trendline demand for the last 12 years. So we have to prove a price to get to that type of a demand, I think, especially if, Ben's comments about safrinha crop earlier just being bigger. But this chart in orange shows that in the last 10 years, the December seasonal low has gotten earlier and deeper. And it's happened more towards the end of August rather than in the prior, decade before that. It'd be more like an October 1st low. So if that's our new low, maybe it's because of the function of these contracts, basis contracts, end of the line is going to be in August. If that's part of what's the phenomenon that's weighing on prices in August, to your point, Justin, now's the time to consider, okay, if this is pushing you into double payment territory, crop insurance, PLC, hedging, some triple payments potentially, we might want to keep this in mind. The seasonal low has been end of August. And even though we've got this massive USDA yield print, to your point, Dan, what are people trading? That might be a gift for us if that pushes us into the 375, 370 zone. Even there, you're going to push a lot of 85% policyholders into the money on insurance, as long as it sticks there. In 2014, it didn't stick, right? It rallied right through that insurance window, and a lot of people didn't receive the payments that they would have been expecting going into October 1st. We talked about maybe hundreds of millions of dollars of insurance revenue that was wiped away on that rally in October of 2014. So same thing could happen here for those big policy holders. If there's an unexpected rally into October, we want to just, to Justin's point, be mindful of that and try to make our hedges around that.
So to add to that, 2014 is a good example, right? Because that was a really big yield, record yield. Everything looked great. I remember that year very good. And so if you look at today's date then, right, we were trading 365-ish, let's call it. Right. So we kind of had this trying to bottom out in August, kind of 365-ish. Obviously the yields kept being strong on the reports. Ultimately made the low on that October 1st, right down at that 318, 320 level. Right. So between those two seasonals, it actually hit perfect on the older seasonal, because your other one's 214 to current. So I think that, if we prove that big yield, that's what should continue to happen. We'll have to move so many bushels. It'll keep breaking. But I think just knowing where those levels are. So it's, call it between now and October 1st when they start pricing crop insurance or setting those prices. Right. I think that's where that really important to know those levels and that time frame, how to play that strategy. So,
Yep.
At some point, if it were to, the faster it goes down and the farther it goes down, then it really doesn't matter on the timing because you're just hitting those levels and you kind of know those numbers. Right. So I think it's important to know both the levels and the timing.
This is good stuff, guys. And as always, give us a call. We're doing this stuff every day. We're going through this with our clients. Be more than happy to visit with you folks. Nick has a quick question here, and then I'll throw this to the room. What are the standard deviations of those two data sets? Any certain years skewing those trends? Dustin, you might have a little insight into that.
I don't have that off the top of my head. I can find that for you, Nick. But yeah, I'm sure there's going to be years like 2012 where I think we hit the highs in August that year, right? That may be skewing that first report. But keep in mind, though, these are still weighted to the percent of that individual growing year and then weighted from that to the rest of the growing years. So it's not like an $8 price in 2012 is going to go and massively skew out all those other years because it's still just a percentage of that highly priced year. So
very good.
I can find it for you.
Yeah, we'll get that to you, Nick. Thanks for the comment there. Quickly here, let's move over to livestock here, guys. Rye, volatility is here to stay, I guess, at these levels. We know that $5 range yesterday in fats and $7 in feeders is pretty gnarly. And then one thing I guess caught my eye this morning was that CME hog index is pretty crazy as we go off the board here. So why don't you give us a few thoughts this morning and then we'll wrap.
Yeah, absolutely. I mean, the market's just, clearly on shaky ground just with, hey, look at the time of year, look at, how high the price is. I think naturally you got a lot of just anxiety, I think, with a market that really hasn't made a significant move down. We're talking an intraday $5 range, but when you look at what we've done over the past month, it's been just an absolutely huge move. So I think you're going to start to draw out a lot of those concerns in the near future. Also, beef prices just kind of took a pause yesterday. Beef had been kind of leading us higher. But you just saw a little bit of mixed bag here. Choice was down 9, Select was up $2.32. So I think there's going to be a lot of focus on that right now, especially with, the typical topping kind of price action around September 1. I think you're going to get guys to try to trade that a little bit further. Plus, we saw a little bit of cash trade, even though the cash was up to $2.37 in Kansas. Nebraska was trading $3.85, so that's $4 higher. You've still got these big discounts on the board, so I just kind of feel like we're going to start to see those prices narrow up. But I don't think anybody's really convinced that the cash market has the capacity to break just because of how tight everything is. But we will see. So at this point, the market's definitely in kind of a vulnerable place, it would seem. But yeah, the volatility is probably here to stay for the time being. Plus, you got a pretty dismal weekly export sales for last week at a marketing year low. So it was only 4,300 metric tons. So maybe we're starting to shut things off. Maybe we're hitting these prices that are just too high on the street. So more to come on that. Probably need to see some more, but would still expect everything to stay pretty volatile. But on the hog side, yeah, clearly cash right now being down a little bit. I think you had a little bit of price weakness yesterday. You took October down to kind of the lowest level in 2 weeks. And I think there's just a little bit of caution here from the massive longs in the market. Managed money's been very, very long here, and we've got this big discount on October relative to the index. And I think everybody's trying to think of what's going to blink first. So we're still in that kind of situation. So I think we need to see a little bit more kind of fundamental weakness in cash and product, just to see those, that gap start to close relative to the index. So it just feels like there's a lot of caution in the meats going into today.
Very good. Real quick, Ryland, maybe touch on just a little bit of your opinion, I guess, on hogs out to December. We had a question come in from Maximilian here.
I mean, I've been on the pretty aggressive side with hedging just because like we are at kind of a historically high price level for this time of year. I mean, um, at this point, you see the big discount relative to where the front end of the market is and the back end. I mean, you baked in a lot of kind of negative sentiment in there. The managed money want to stay long. It's kind of that market where they're likely to roll forward, while still kind of reducing their positions going into the back end. I'm kind of not on the bandwagon that disease has been that big of a problem, from what I'm hearing, but I could be wrong about that. But I would say that you've got an $82, D's hog right now, future. I would be trying to kind of lock in some of these margins that are further out back there. So long put options, I think, is a great strategy. Risk reversals, I mean, all good in my opinion. You can even look at the LRPs if you just want to sit at a floor, and just kind of set it and forget it kind of time frame. I prefer to stay flexible in this kind of price environment. If we see beef prices, cattle prices start to slip, I think that's going to bleed into the hog sector pretty quickly. So I would say just that's what I kind of be focused on right now. Just a little bit of price protection out there, just because, I mean, it seems like we're at kind of a historically high price point.
Very good. Appreciate that. Appreciate all the comments there. As always, if you've got anything else you'd like to visit about or would like a little bit more of a tailored discussion, please give us a call. We'd love to visit with you there. Just came into the open here, so let's get a quick readout. September corn down 2 3/4, 371 1/4. September soybeans are down 9.5 right now at 1014.5. And September Chicago wheat's down 2 1/4 at 505. Tomorrow, very fun day. As always, we're coming back to Fun Fact Friday, and Brian's back in town. We'll see what he's got to say about what Jack did last week. So I know we're still talking about that one. But anyway, Fun Fact Friday, be sure to tune in. You never know what you're going to get. We appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and certainly subscribe. Doesn't cost you anything to do so. It'll keep you up to speed on everything that's going on with AgYield. So again, thanks to everybody that supports the show. We're doing this live every day that the markets are open on X, Facebook Live, and YouTube Live at 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we'll talk to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.